Good morning, everyone, and welcome to this morning's webinar on Cashflow Essentials. We are joined by an expert presenter this morning, Graham Blackadder, and Graham is a business finance specialist, and he's going to be running this webinar. My name is Kylie Pettit, and I am a business advisor with Enterprise Plus. So I will just go through a few things and then I'll hand over to our special guest, Graham. So we want to start by paying respects to the traditional custodians and First Peoples of New South Wales and acknowledge their continued connection to country and culture. And Business Connect is a dedicated and personalised New South Wales government program that provides trusted advice to help you start, run, adapt or grow your small business. Enterprise Plus is a dynamic regional organisation with a long history delivering a comprehensive range of business and educational services to regional New South Wales and the ACT. So please note that our events are general in nature. We don't account for individual circumstances. Later on in the webinar, if you check the chat box, I will put the details or my details as a business advisor, and you are entitled to up to 36 hours of support over 3 years. You can use that for both webinars and also one-on-one business advisory support as well. So I'll hand over to Graham. Thanks very much, Graham.
Thanks, Kylie. Much appreciated for moderating today, and welcome everybody. I hope that the session will be useful for you in your business endeavours. A little bit about me, firstly. University trained and CPA qualified, 40 plus years experience in commercial life. Most of my background has been in multinational corporates as a CFO, finance director, company secretary type, and across a broad range of industry sectors. And that's the beauty of being an accountant. I guess you can change jobs without actually having to change your vocation. It's changing scenery, sometimes useful, and it's how you learn stuff. I hear you asking, well, how does that help me in my small business when he's had so much experience in large corporate business? Well, I have had first-hand experience in small business as well. Firstly, as a CFO, a large chunk of my role in many situations was exploring opportunities to acquire small businesses into our fold. As add-on business, as complementary business, and of course part of that process is what's called due diligence, and that's where you start to delve into what makes a small business tick. And I saw many aspects of small business across many years, and also first-hand experience from a personal point of view when my wife said to me one day driving to the city, I should be doing this for myself. Now, she was a very seasoned, long-time personnel recruiter, and she was working for businesses, often being headhunted. And I think she'd just been headhunted into another major firm when she said, I should be doing this for myself. So I said, if you're serious, you should. You're passionate about it. You love it. Let's set up a business, and if you're keen. And so from a standing start, we created a business plan. I grilled her about numbers to make sure that the dynamics would work, that it was going to be viable. And of course, we did some budgets, cash flows, and all of those things that go into making up a business. And of course, I stayed in my corporate role while she in the little rented premises in the heart of Sydney CBD that we rented. She started with herself and a computer and an off-sider that she'd employed to grow the business. And I'd travel the world in my role, oftentimes with Blackadder Recruitment Company budgets and cash flows and accounts in my briefcase, and that's where a lot of it got done from my point of view, is from the back office, while she was feet on the ground and grew the business from a standing start, as I say, into a multi-million-dollar business, which we ended up selling some time on after many years, and as a viable operation, and still operates today. Probably not in the same way. It's no longer family owned in that sense, but it went into a bigger recruiting conglomerate. So yes, first-hand business, first-hand experience in small business, and hopefully, and I'll refer to that experience oftentimes through today's session to give you a bit of a personal flavour over something. And of course, I mentioned the word passionate a few minutes ago, and however your business has started, or you're thinking of starting, whether it's growing from a passion or something like a hobby, or something that a skill you've learned over many years, like Narelle did in her recruiting experience. Once you lay a commercial application over the top of it, and you turn that hobby or passion into a business, it changes its complexity, and it's no longer something you can just dabble in when you feel like it, go into your art room and do a bit more to a painting. It's something you have to work at every day, and with that comes accountability, the difference between success and failure, compliance obligations, solvency, liquidity, profitability, all of those things. So, it can still be a passion, but there is an accountability, a commercial risk, which you have to manage and which you're ultimately responsible for. So with all of those things in mind, let's push on. Let's look at our learning objectives and outcomes for today. I want you to understand the key financial tools available to manage and grow your business. I want you to learn about what we call the 7 levers of change, and how to use, I call them 7 levers of change. These are cash flow levers, and how to use them to your advantage. And the importance of a detailed cash flow forecasting for both profit and cash as your roadmap to success. I mean, it's that critical. And your learning outcomes, well, as I say, I want you to learn it. I want you to have a good understanding of cash flow. It's in a relationship with balance sheet and profit and loss, and its critical importance in starting up. So before you even start a business, look at, as I mentioned before with ours, the viability, is it going to be a viable enterprise to take on, or won't it fly? So the cash flow is critical in that assessment right at the get-go. And then as you grow your business, it's ongoing. So a good understanding of cash flow is an important continuum. A good understanding of the 7 change levers and the practical measures you can take in your business to optimize your cash flow. And of course, a confidence to undertake and maintain ongoing cash flows for your business. So, you can't fob it off to somebody else necessarily, though you may want some professional assistance to get up and going. But I keep saying the buck stops with you. It's your business, and you can't stand there down the bottom of a deep hole, scratching your head saying, how did I get here? Take charge and understand these things, and they'll stand you in good stead. So our agenda today, a brief recap on some of the fundamental financial relationship concepts and the key accounting tools that follow from those fundamentals. How cash flow inputs come straight out of your financial data, and of course, the 7 levers of cash flow. A little bit about working capital, the balance sheet inputs to your cash flow. Working capital is a much bandied term, but hopefully I'll give you a better insight to that today. The operating elements, the profit and loss inputs to your cash, your break-even analysis, and then ultimately preparing a cash flow, what it looks like and how to maintain it. So that's our agenda for today. So, of course, the 3 questions of your business for you should be, where am I at? Will I be profitable and when? And will I have enough money? It's all about cash at the end of the day. So cash flow essentials, where do we start? Well, as well as this webinar, I also do webinars for Enterprise Plus on financial fundamentals. And I also do one on budgeting for profit. There's another one within the suite that I don't do, that somebody else does, called pricing strategies. So there are a realm of financial webinars that all come together. But the 3 that I do, this one, the financial fundamentals, and the budgeting for profit, are all intertwined. And so if you've attended any of those other workshops or webinars that I've done, you may have heard some of these things, but I think it's important as a starting point that you've got a good grasp of these. So the more times you hear them, don't put it down as droll and uninteresting, or I've heard that before. Take it as a positive and say, I need to understand this. This is important. So the concepts of double entry, debits and credits, assets versus liabilities, income and expense, those sorts of things. Do you understand these? So we'll do a little bit about that. And do you understand your basic financial reports or tools? For example, your balance sheet and your profit and loss, which flows straight from those concepts. So this is our starting point. This is a model that in the financial fundamentals one I build up over a series of slides, but it's a matrix that I think gives you the nuts and bolts of everything you need to know. Down the left-hand side, you can see it's split between balance sheet and profit and loss. So they're the 2 main tools that flow out of what we call a chart of accounts or a general ledger, where all your assets and liabilities and expenses and income are recorded and balanced up. And so to understand that for every debit there's a credit, so that's the concept of double entry. So when you spend money out of the bank, it comes out if you've got cash in the bank and it's your cash and you spend it, it reduces your current asset, and you might so that'll be a credit to a debit account, which is your current asset, so it reduces your asset. But it might be you bought stationery or you bought some inventory. So if you bought stationery, it might go into expenses, overhead expenses in your profit and loss. If you bought inventory, then it will go into another current asset called inventory. So see how it moves So your general ledger must always be in balance. The debits must always equal the credits, because for every debit there's a credit. And those entries can flow between balance sheet and profit and loss. In other words, across account sections, if you will. So it can flow between income and assets, or it can flow between liabilities and expenses, that sort of thing. Or, as we just exampled, it can flow between two current assets within your balance sheet. Doesn't actually have to flow outside. But that's important for you to understand this concept, double entry, the general ledger structure, a chart of accounts, and the two reporting tools that flow out of all of those entries. So straight up, these are your two accounting tools, and that flow out of all of those entries. But just before I start to talk a little bit about those, it's important for you to keep good bookkeeping records. And, when I learned accounting, back when Adam was a pup, it was all manual, and we had to handwrite ledgers and use adding machines to balance sales and all that sort of thing. In this digital age, and of course I was in the computer industry back in the 80s when PCs were first put to market. And so I've had a big career in electronic accounting through mainframes, and of course in more latter years in PCs. When Narelle and I started our business, I scratched my head and thought, well, how am I going to account for this? I can't afford an IT department with a big mainframe computer and people to code software for me, all of this sort of thing. And so I took a look around the marketplace, and I found something called MYOB, which funnily enough stands for Mind Your Own Business. Some people call it MYOB, but MYOB was the one that took my eye straight up. I installed it. I worked out how it should work. I taught myself to use it. Being an accountant, that was a benefit. Obviously, I knew what to expect out the other end, and it stood us in good stead. So from day one, our business started once we'd decided that was a viable thing to do, and we'd financed it and all of that sort of stuff, and we opened the doors, our accounting entries were already up and running on MYOB. And of course, we were able to produce balance sheets and profit and loss, and when we employed staff, we were able to use MYOB for payrolls and other elements of reporting as well. Today, I don't use MYOB so much. I've had some more recent exposures to other products. Xero is one that comes to mind that is doing well in the marketplace, and that's another option. QuickBooks has been out there for a long time, and there are a myriad of other ones coming down the pike now. So there's no excuse really for you not to get a good accounting package at a relatively cheap cost. It'll pay for itself in no time because of the information about your business you can get so readily, so quickly. But be careful. Be careful. If you don't know what you're doing, seek help, because there's an old adage in accounting terms, and especially in this computer age, garbage in, garbage out. You put stuff in wrong, and we go back to our double entry slide and all that sort of thing, and you post stuff in the wrong place. I heard of an instance where small business operator was asked what his GST liability was. He said, well, I don't have any. My accounting system tells me I don't have any. Well, that was only because he didn't record his purchases and his sales correctly. And so the GST component he expensed or he took to revenue account instead of taking it to a GST liability account and recording a future liability. So be careful, garbage in, garbage out. Now to these two accounting tools that come out of the system so readily from all the inputs that you put in on a daily, weekly, monthly basis. Your balance sheet is your position statement. It talks about where you're at today. It's like going to the doctor and he puts the stethoscope on you or put the blood pressure machine on your arm and straps you in and pumps you up and says, your blood pressure at this point in time is this. That's your balance sheet. It's your position statement. It's where you're at today. It doesn't tell you how you got there or anything like that, or it doesn't even tell you where you're going. It tells you where you're at today. And your profit and loss is the other part of the equation. As you remember back to that matrix I showed you, if I can get back to that, this one, your profit and loss is the thing that records your incomes and the expenses against that income that produce your profit or loss. So that's the other one. So that's really your performance report over time. That tells you how you've gone, what sort of expenses you've incurred in getting there, what revenue you've been able to produce along the way. And the net result is your profit or, dare I say, loss. You're not in profit yet. And of course, your ambition is obviously to succeed, so you want to be in profit. But these aren't the only accounting tools that are available to you. There's a third very essential accounting tool called your cash flow. And look, this is something that people glaze over when they hear because they don't know what it is and they don't know where it comes from, and they sort of say, well, I don't really know how to get there, so I won't bother with it. So we're going to talk about that very point today. So remember the three big questions we had, and I suggested you should have your business. Where am I at? Well, of course, your balance sheet answers that. And will I be profitable and when? Well, that's your profit and loss up until now. It's your operating budget going forward. And of course, from those documents, either from your historic P&L, if it's in profit, you've already broken even. If your operating budget going forward is trying to take you from loss to profit, it's going to show you at some point when you break even. So that answers the when will I be profitable. And of course, the third question that I propositioned you with, will I have enough money, is cash flow. And so, you know, your operating budget and your cash flow documents are really what I call prospective. In other words, they're about future performance, whereas the balance sheet and the profit and loss statements are retrospective. They're historical, and they're not going to, they'll be your basis for going forward because it's from where you're at now that you need to go forward. Your profit and loss up until now tells you where you're at or how you got to where you're at. And if you haven't gotten to profit, you need to understand when you will. And of course, will I have enough cash to get me there? So, you've created creditors along the way, people that you bought stuff from that you haven't paid yet. You've got to pay them. You've got staff that are employed, maybe, that need to be paid their wages. You've got to have cash in your business to do that. And of course, the nice thing, and we did this in our business, we preserved cash for growth. So as we were able to grow our business from one person on the payroll, aside from ourselves, and I ultimately, we got to a point where the business, Narelle had grown the business so large, I could no longer do it on a part-time basis, sitting in 1A on Qantas, jetting off to London or New York. So I had to take a decision. Would I give up my day job and virtually come into the family business, or would we employ an accountant into the business? And we took the decision that, hey, I'd retire into it and take it on full time, running the back office, and to make sure that we were in good stead. We were able to maintain the level of reporting. And of course, we were growing our staff all the time. We'd generated enough cash and preserved enough cash by controlling our expenses to provide for growth, to put more desks, more computers in place, to pay more people, and to grow our business. And so cash flow is that catalyst that does all that. So I get to this point very quickly where I always say cash is king. If you haven't got cash, you're going to struggle. And we'll talk a little bit about in the next hour about balance sheet aspects of cash flow. And one of them is whether or not you borrow money. Well, we took our business proposal to our bank, and they gave us, they thought it was a good proposal, and they gave us a line of credit. We had an overdraft, etc. We used that to set up and to get going. Narelle also didn't take a wage for the first 3 or 4 months until she had enough sales in the kitty to pay herself. But she made sure that our overdraft was sufficient to pay the people that she had working for her, to cover her, to extinguish her expenses that she'd grown until she got into that, what we call a break-even point. Now, she worked day and night to get that overdraft paid back in record time, and within the first 6 months of our business, our overdraft was paid back. We kept it for many years until the day we sold the business, when we retired, because it was in our name. But we didn't rely on it. We paid it back. It sat there undrawn for all those years, having used it initially to get the business up and going. And there were things that we would have liked to have done where we could have extended it and reused it, but not until we said we can afford it, that we've got a cash flow that's sustainable, where we can buy these things. So don't, when you start off your business, think that you can go out and buy up every bit of things that you think you'll need in your business. Be careful that you manage your cash flow to spread it over the future and keep some money in reserve. But cash is always king. We got to the point very quickly where we didn't need our overdraft and we relied on the cash we were generating. Cash is how we measure our worth, by what we take home. As a business owner, knowing that you can meet your debts as and when they fall due This is called operating solvently. And as a company under the corporations law, it's a legal requirement. But for any business, if you don't have the cash and you've got no cash resource, like borrowing capacity, you go out the door backwards and, as I say, end up at the bottom of a hole, scratching your head saying, how did I get here? So stay focused on your cash. Don't glaze over. Cash is always king, should be your new mantra going forward. So how do we get our cash flow? Well, it draws elements from both the balance sheet and the profit and loss. So the very two fundamental tools that come straight out of your accounting system from all the source documentation that you record, whether they're sales invoices or purchase invoices or payrolls or whatever they might be, is drawn from those two documents. So, that's your starting point. Before we go into it in any more depth, let me just give you a couple of quotations which might incentivize you. And I've taken this from a small business blog quite some years ago, and I thought these were very useful documents, very useful quotes to encourage you to focus on your cash flow as a critical part of your business. It's the oxygen in your business. As I said, if you don't have your business, you don't have cash in your business, you won't survive. So it's the oxygen in your business. The one that I think is quite damning really is poor cash flow management is cited as the reason for as much as 82% of small business failures. Now, that's how important it is. Most businesses fail because of their cash flow or their inattention or their inaptitude in looking and managing their cash flow. And the one that I think is very encouraging, and this is again, I encourage you to think of it in these terms, cash flow is simple. Money comes in and money goes out. So think of it in cash. Now, when accounting gets more complex, we get into accrual accounting and all of those sorts of things, whereas you usually start out in a business environment just accounting for it on a cash basis. And the tax department asks you this, whether you're doing income tax or GST reporting or whatever it might be, are you accounting on a cash or an accrual basis? But keep it simple initially. Cash flow is simple. Money comes in and money goes out. The ATO, the Australian Taxation Office, some years ago, to encourage small business, because small business is a major part of our economy, to encourage small business to focus on their cash flow aspects of their business, auspiced through a major consulting firm, what they called an interactive workshop cash flow coaching kit. And out of that came these 7 levers of change. Now, the cash flow coaching kit is a series of flashcards, it's big workbooks, and it's very much for a schoolroom environment. COVID put paid to a lot of all of that happen. In some cases, workshops have been great online, but even in an online environment, it's not as good as being in the classroom when you can put your hand up and just ask a question and things can be demonstrated easily. So, the face-to-face is going away for some years, has limited its capacity. But the 7 levers of change, or the 7 change levers within that coaching kit, based on cash in and cash out, are very real and very simplistic in their concept. So let me just flip the page here on my work page and I'll take you to this. Oops, I've gone one too far. So the 7 levers of change are those things down the middle. There's pricing, there's volume, there's collecting money or people that owe you money, debtors, accounts receivable, whatever you want to call them. There's asset control, where cash is going out. So cash comes in from pricing policy and your volumes that you sell and the debtors that you collect. Your cash goes out from assets that you buy, expenses that you expend, inventories that you buy, and people that you employ. So they're your 7 levers. What I've done, and I've broken them up in cash in and cash out, which is part of the 7 lever concept. What I've done down the right-hand side is show you where you collect this information, where they're focused. Pricing and volume are very much the province of your profit and loss. They're what drives your revenue. Whereas your debtors, your accounts receivable, is a balance sheet concept. As is assets on your cash outside, where you're employing assets, you're buying assets, you're spending cash to get those assets. Expenses, we mentioned stationery before. Expenses can be a range of things. They can be accounting fees, they can be telephone account, they can be all sorts of things. You can also have direct expenses or direct costs related directly, which is another element of cash. So you've got another element of expense. So you've got 2 types of expense. You've got your direct cost of sales, which come up above your gross margin line, and then you've got your operating overheads, which come below that before you get to your profit or loss. Your inventory, of course, are things you buy that are going to be employed either for direct on selling or employed in a production process that you carry on in making the widgets that you ultimately sell. So inventory is an asset until you use it in your production or till you sell it. So your cash is going out to acquire inventory. And similarly, staffing is a profit and loss thing because it's the wages you spend. It's a period expense. You spend it now. It's for work done now. And that's why it's in your profit and loss. So we're going to look at these things. We're going to look at the profit and loss and balance sheet elements of cash in and cash out, all working up towards how to produce a balance, a cash flow statement or projection. So let's start looking at the balance sheet side first. And I mentioned this term working capital, much bandied around, but I've given you a bit of a definition. It's the capital of a business or the cash in a business, which is used in its day-to-day trading operations and calculated as the current assets minus current liabilities. So it's those things that are very, very, they're less than 1 year life expectancy, or they've only got a very short-term life. As they're moving, they're turning over quickly. Long-term assets or fixed assets, things like machinery and equipment, furniture and fixtures, they have a much longer life that you amortize over their useful life. Current assets move on a very current basis. And similarly, current liabilities, and I'll be giving you some examples here, your overdraft, your creditors, people that you bought from that you owe money to now, or at least in the next 30 to 40 days. Taxes that tax liabilities that you've accumulated that you've got to pay for quarterly, usually, PAYG, which is your payroll deductions for income tax off employees' income, the GST, the net between what you've collected and what you've spent on the way through. And so the net difference is what you owe the government. and then any other short-term borrowing. So current assets minus current liabilities is the working capital employed in your day-to-day operations. Now, I've done a very interesting thing there. I call these things in current assets that aren't cash, near cash assets. So why do I do that? I'm going to show you why. Because if they're near cash, their ability to turn into cash is very much within your control. And I think that these are the things that you can focus on to improve or optimize your cash flow by turning these things into cash. Or in other words, not harboring things on your balance sheet that aren't cash, that could have been held in cash, that end up being a liability. Interesting, isn't it? I say that with a bit of tongue in cheek. But let me explain it to you this way. Working capital can be improved by reducing inventories and accounts receivable. In other words, speeding up their conversion to cash. Let's talk about inventories. Inventories or stock in trade, stuff that you buy to resell or to use in your manufacturing or production process, raw materials of sorts. Don't buy inventory beyond a reasonable expectation of usage. In other words, I've been into businesses where people are carrying inventories that are way too long. In other words, they won't possibly use them based on their current rates of production and their current sell-through rates within the next 12 months. And it could be that depending on what they either become obsolete or their shelf life expires, depending on what they are, as I say. Whereas they could have been held in cash and bought on a shorter lead time basis. It's what we call just-in-time inventories or just-in-time purchasing. In other words, don't buy it before you really need it in your business. And of course, I say that, but having to take into account also supply chain issues. And that's what we've seen in COVID, where supply chains became almost impossible to maintain. And so people ran out of stock and couldn't supply or couldn't finish projects because they were waiting on stuff that had such long lead times because shipping was delayed because of COVID, because manufacturing was in foreign places was delayed because of COVID. And so you do have to take those exigencies into account, but in a normal situation, try not to carry more inventory than you need to run your business, because, as I say, it can run out of shelf life, it can tie up cash, it can become obsolete, and of course you're struggling for cash because it's tied up in inventory and you can't pay current bills. So you've got all these knock-on effects. One of the things I say is always look at inventories in terms of what you expect to sell, or what you expect to manufacture. Accounts receivable, it's a difficult one, inventories, because, but not totally difficult. Even if you get it a little bit wrong, it's better to have less inventory than too much inventory. Accounts receivable is an interesting one because you've made the sale, but you've sold it on credit. So you've sold whatever it is, unless you're running a cash business, and I have to just qualify this next statement on that basis, that if you're running a cash business, in other words, you're selling coffee and in a coffee shop and you'll take cash over the counter, then you've got a cash business and you won't have an accounts receivable situation. You may have an inventory situation, but you won't have an accounts receivable situation. But for those businesses where they've made sales and they haven't received cash for it over the counter, they've in fact incurred what we call, and it is always traditionally called, credit sales, because these are sales sold on credit. And how that works is your sale goes to revenue account. Obviously, your GST goes to GST account, but just looking at the sale component, not the total sale, but the total sale of the invoice. In other words, that's the sale component and the GST component. In other words, the total amount payable by your debtor goes to a current asset called accounts receivable. And that's what you will collect. In the meantime, you've recorded a sale of so much, and 1/11 or 10% has become a GST liability to the government. And so it behoves you to collect that accounts receivable. What we did in our business, and we did it right from the outset, I said, well, and there was a formula for how we sold. If it was a permanent placement, that was based on a starting salary and a percentage. And I said, well, if we're selling on 30 days, that money is going to sit out there in lower land, and the person that got the benefit of the placement, that's got the employee now, might go broke or not pay the bill for whatever reason, and we're left high and dry with a bad debt. So how about we put a little panel, a discount panel on the face of our invoice when it goes out, which says, if you pay me in 7 days, I'll afford you this discount. And it showed the discount level and the GST discount. For the net amount that they would pay if we received it, and the offer was only valid if we had the money in our account, and we encouraged people to pay by EFT, direct payment into our account, rather than by check or whatever. But of course, in those days, still a lot of people paid by check, and we still had the bank and all of that sort of stuff. But I was encouraging EFT payment even back then. And if we had it in 7 days and they took this discount, they got the benefit of a not insignificant discount on their major investment in a new person, permanent placement employee. We got compensation for our work in 7 days, within 7 days instead of 30 days, and could have possibly been 45 or 60 days, I don't know. But most of our clients always took advantage of that discount. So assess that in your business to see what you could afford to do to encourage people to pay earlier. And we never had a bad debt. I think we had one over many years that went bad, and I went through, and look, they went broke for a whole heap of reasons, not because they were dealing with us. And we actually had to write one bad debt off in our business over all those years. And so our business was squeaky clean from that point of view. We always collected our receivables. There are other ways to do it. You can factor your debts, and there are factoring companies out there that have been out there forever. Mercantile companies, as they might be called, factoring companies. Well, they'll take your debtor's book and say, well, look, we'll give you 80% of your book. will pay you cash for it, we'll take it, we'll collect the debts. Now, if they can go out and collect 100% of them, then they end up with a 20% profit for their efforts. But our business will be down, or your business will be down 20%. I'm not advocating that sort of discount. That's another way people did turn their hand to getting their receivables down. Just while I think of it, on inventories, I had a mental block there a few minutes ago, but one of the ways of if you think you've got excess inventories, and you go into eBay sometimes and you see all this stuff for sale by reputable vendors, and they've got good credit ratings, all that sort of stuff. What they are, they're people acting almost incognito, as it were, selling off surplus inventory, perhaps at a price discount than their normal retail pricing, to get rid of it, to turn it back to cash. So it's not dissimilar to the discount offer on the accounts receivable invoice. So think about that. On the other side of the balance sheet, where you're looking at your liabilities and how you can improve your working capital in your business or improve your cash, is by increasing or slowing down their draw on cash. In other words, don't pay your creditors 30 days as you contracted to do, pay them 45 days. Now, I'm not advocating this. I've never have. I don't believe people should wait for work they've done or goods they've supplied. I'm just the same as I didn't expect to have to wait too long for things that we'd done in our business either. So I'm not advocating that, but it's one way you can do it. And big companies do it all the time. They say, well, we're not paying, we don't care what your trading terms are. If you buy goods off us, if we buy goods off you, we don't care what your trading terms are. We're only going to pay you 45 days. Now, they're doing it to you. You might be forced in turn to do it to others, but I don't advocate it. You're in a small business market, and if your suppliers are small businesses, they're relying on your ability to pay on time to keep their businesses going. Again, turn it around and look at the accounts receivable thing to get your money in quicker. So it's not so easy to increase or slow down liability draw on cash in creditors, or renegotiate, or even renegotiating borrowing terms on bank loans or whatever it might be. But they are things that are possibly there to improve in a dire situation. I would recommend the more positive thing to focus on is in reducing or speeding up the conversion to cash of current liabilities, your current assets, your near cash items, your inventories, your receivables, particularly. Okay, I hope that's a helpful little aspect to look at. Now, we're running out of time here already. Other areas of balance sheet considerations, a major drain on cash resources is the investment in fixed assets. So, there's got to be a planned approach to buying your assets. As I said, we had an overdraft when we started our business, and but we couldn't go out and buy every whiz-bang thing we thought we might need. We started off very meager and then grew it as we could afford it. So there's got to be a planned approach, a capital budget to the assets you think you might need or would like in your business to enhance your business, but over time as you can afford it. So be careful. Types of assets, land and building, plant and equipment, furniture and fixtures. Consider alternate funding sources to assist your cash flow. There's all sorts of things. There's financing through operating leases, sale and leaseback of you might have invested in a piece of equipment that you can actually sell off and still have the use of by leasing it back. Again, like I mentioned with inventory, sell off underutilized assets. Review your funding structure and availability. consider venture capital or equity participation. And this one's particularly good, and it came to the fore through times of crisis, whether it be bushfire, floods, COVID. But applying for grants has become the name of the game, and they're out there. They're to be had. Your advisors in Enterprise Plus and Business Connect can help you in that to supplement income stream. If you think qualify, get professional help to put you on the path to securing grants. But look at other ways of funding your assets. So we've talked about balance sheet aspects of cash flow, cash in, cash out. As I say, I encourage you particularly to look at debtors, the way to speed up getting your debtors converted back to cash, to making sure you don't carry too much inventory, and to actually refinancing assets or fixed assets or those things that are a cash drain on your business. So now to the profit and loss. I just throw this in here. It's like the dripping tap. Cash is always king, your new mantra. Don't forget it. So let's look at these things now. The profit and loss aspects of cash flow, the things that affect your revenues, which is cash in, and your expenses, which is cash out. So you've got direct expenses, you've got overheads or operating expenses, you've got wages. They're all expenses in a sense, and they all come out of your profit and loss. They're all recorded in your profit and loss. Critical appraisal of them all is forever important. And we're going to look at those ones now in the next half hour. So we're all about optimising profits or maximising cash. But think about it in cash terms initially. We want to increase our revenues and improve our margins and manage or contain those things which are overhead expenses in the business. Your light and power, your telephone, your computer expenses, your accounting expenses, your marketing expenses, your legal fees, your printing and stationery. I mean, there's a myriad of them. So now we get down to, oops, I've gone too far. So we want to do an operating budget because that's the first leg in getting these things reported. So it looks like a profit and loss. It's your sales minus your cost of sales to give you your gross profit. And then it's minus all your operating overheads, starting with advertising or A and going through the Z, and to get your total expenses. And that'll include your wages at some point or your salaries, your staffing costs, which will all appear in that bottom section of total expenditures, to get to your profit and loss on a monthly basis, phase it out over time. So, and you look at your last year's profit and loss to give you your next year's likely operating budget in profit and loss terms. And of course, across the bottom, I just made a note there that a cumulative P&L, so as these months accumulate over time, you might find that if they're not already in profit, you're not already running in profitable terms, there'll come a point where you break even and they then go to sustained cumulative profit. But the first time that happens on a sustainable basis, that's when you've broken even. So let's look at the change levers. And here's where the change levers come in. Your first change lever in your product cycle, your sales cycle is pricing, and your second one is volume. So in pricing, you've got to talk about is my pricing sufficient to cover expenses? There's not much point selling stuff at a loss. I worked for a major manufacturer of heavy road equipment, and I was employed. I went into the state to take this cream job as finance director, company secretary. Unfortunately, because it was a private company, I had no access to any financial data on which to make an assessment, but I took it on the words of the auditors that it was a viable enterprise, worthwhile making the move in a state with a young family. And I opened a cupboard in the accounting office. I inherited this big accounting department. I opened this cupboard and out there were all these checks on it. What in the hell are they? And they said, oh, they're checks we can't afford to send out. We've got no money to cover them. So I said, why would that be? Oh, we're not trading profitably. Oh, why would that be? So we had a costing department. I said, show me some units that have been produced recently. I found on day one, I found not only a cupboard full of checks they couldn't afford to cover, but I also discovered that each major unit of production that was coming off the production line was being sold at a retail price or a wholesale price to a dealer at a price less than it cost to make. So, you can't possibly make money that way. So anyway, that's the major thing. You got to make sure that your pricing is sufficient to cover your expenses. You've got to know what your production cost, your cost of production are to put it as a finished product on the shelf. Then you put a margin on it to sell it. And your margin has got to be then sufficient to cover your overheads. You can see how all these things are intertwined. Cash flow doesn't sit out to the side and say, oh, I'm different, I have nothing to do with you. It's all intertwined. Profit and loss, balance sheet, pricing, volume, sales, cash flow. What is the competition charge? You got to be careful. You can't go out there and just sort of say, I'll put the price up. You might price yourself straight out of business. If it won't fly in the marketplace, now you might have a competitive edge that makes your product more attractive. That's when you can start leveraging price. And certainly consider small strategic price rises such that, as costs go up, you've got to obviously edge up your pricing structure to deal with that. And volumes are important because volumes change. It's not necessarily a flat line. When you come to do your budget, remember this line here and you're looking at your sales line across the top, it won't necessarily be the same amount. It won't be $1,000 every month. It might have peaks and troughs depending on seasonality. And similarly, your production will vary from time to time too, along the same line. So consider volume, consider seasonal fluctuations, what they will do in, you might have a range of products and they complement each other. So when one product's not doing so well because it's cold, another product is. And so they compensate where it's vice versa in the warmer climates. And so, it might flatten out because you've got complementary products that take up those slacks, but consider seasonal fluctuations in volumes. Consider market downturns. Look what just happened in COVID, businesses all of a sudden had market downturn. People weren't going to town, they weren't buying their coffee. Businesses couldn't stay open, they couldn't trade because always what we always used to call in our SWOT analysis, upside, downside analysis. What happens if my market falls 10%? What happens if my market grows 10%? You know, so consider market changes in your volume assessments. Because when you're doing your cash flow budgets and you're looking at your sales, you're not saying, oh, I'll just make $1,000 a month. You're saying, I'm going to sell so many of these widgets and the price is going to be this. So these change levers are influencing your end sales result. And would increased volume. So if I increased my volume, it could be production volume. If I increased my production volume, would it convert to increased sales? So you've got to know your market from that point of view. So this is not a numbers exercise. This is understanding your marketplace, understanding your business, understanding your competition. You've got to know what the market will bear. You've got to see where your place in it is. And these change levers are critical in bringing together that sales forecast. And remember, we're talking about sales as being cash in. This is your revenue line and your cost of sales, whether it's coming out of a finished inventory, you've had to make it, you put it in there at a price, you've got to be able to mark it up, cover your overheads, all of those sorts of things. So these two things are critical. Just to reiterate from a production point of view, because this will influence costs in your business and impact your cash flow. And this is a subset of your operating budget in the sense that you're making stuff to go on the shelf until you get to sell it. So do you want to spend all your cash making stuff that then sits in your inventory as finished product, but you've got no sales or haven't got increased sales to cover that ramped up volume that you've now got? So, and it takes cash to do all of these things. So don't build inventories if you haven't got a market for them to sell them. So should I make more or less? As I said before, consider the sales cycle, the seasonal aspects of it. Am I sourcing my raw materials at the best price from the best place? You've got to be careful there because it might be the best price. Is it the best quality? So don't substitute price necessarily for quality if it compromises the ultimate sale in your marketplace. And with production volumes too, look at your labour force on your production line, assess productivity. Have I got too many operatives on my production line sitting idle if I'm turning production back? Maybe the way to look at it is to say, I'd be better off with a core of key people. And when I ramp my production up, I bring in temporaries to complement them to cope with the increases, but then lay them off as soon as it. Don't harbour costs in your labour force that aren't productive, aren't 100% productive. And then, of course, even in your production process, you've got fixed and variable costs, things that will change as volumes change. So look at those aspects. I can't necessarily give you a blueprint because across a range of businesses, these things will vary. But I'm looking at the more complex business, and hopefully for those of you that are running more simplistic operations, these things have become naturally more easy for you to control as well. So for each product that you're making, you have to go through this process, and then you might have to roll them up into a final sales process. So in other words, underneath this document, there's a whole, there's individual products that roll up, and that's where you can use Excel spreadsheets to do these things quite attractively, where this front operating budget is the result of underlying pages that roll up into there so that you get a true flow on where your revenues are coming and where your costs are coming. Now, again, I reiterate our key objectives here. We're looking to break even, obviously, and we're looking to improve productivity. And of course, we're looking to optimise profits and cash. So we've talked a little bit about the change levers that will help you break even from a sales point of view, because they'll be your price points, your volumes. We talked about productivity from the point of view of managing your inputs, the pricing of your raw materials, the temporary nature of full capacity staffing, and of course, all of this will influence your cash result. Now, I found a tool, and I won't go offline and go into this document and make it interactive. This is just a snapshot of it as a slide. But the beauty of this little Excel tool, and we can make it available to you if you go through Kylie and approach her. She can get this tool for you from our suite of stuff that's there. But it's a break-even analysis tool. It's very simplistic by nature. It looks at break-even in various guises. So each one is separate. The fundamental thing you really need to know is what are the fixed costs in my business, and what's the relationship between my selling and my cost price. So they're the things. But the top module, if I can just very quickly look at this, the top module talks about total sales value you need to break even to cover your costs. So we're talking about total value. The second one, the second module, if you know, so just before I go on the second one, the first one says sales. If I know if I'm thinking of making sales of $50,000, and I know that my cost of sales on $50,000 is $10,000, so it's 20% of my sale value. And I know that the fixed overheads or costs in my business annually are $25,000. Then this model will tell you in the shaded areas, it will tell you your gross profit is 40. Well, you could have done that in your head, and your net profit's 15. But the thing that's harder to determine, and this model will do it for you on that very last line of that top module, it will tell you that your break-even sales value is $31,250. So whilst you're making $50,000 worth of sales, or forecasting $50,000 worth of sales, to cover the costs that you're talking about and the relationships between cost of sales and sales on a unit value, you'll need to sell $31,250 worth in a year to cover that all off. And that's where you don't have a net profit. Your net profit is zero at $31,250. If it's $50,000, as we said it was, then of course your net profit's going to be $15,000. Now the second module looks at break-even volume. And if you know your selling price is $5 a unit, and you know your unit cost is $1, so the same relativity as I talked about with the first one, where we said our sales were 50,000 and our costs were 10,000. If we know the unit pricing is 5 and 1, and the expenses or the fixed costs are still 25,000, then what it's going to tell you is, what this model is automatically going to tell you is, that at those pricing structures, your unit gross profit is 4, which is 5 minus 1, which is easy. But importantly, you're going to have to make or sell, you're going to have to sell 6,250 units volume to break even. Now, that's an important thing to know. You can work all these things out manually longhand, and it can be very touch and go. But I just thought that this was a valuable little tool for you to have. The third one looks at pricing. So if we took the 6,250 units that the second module told us, and we said that our unit cost of each one is 1, and our overhead is still $25,000, then our break-even sales value is $5, which is consistent with the example we used earlier. But if you only made 5, or you only sold 5,000 units, and this is where it's important, you're pricing it actually to cover your $25,000 and remembering that the unit cost price of each one is $1. Your break-even sales price is going to have to be not $5, but $6 to still break even, because you've made, or you're suggesting that your sales volume might be less than, what was recommended. So this tool's valuable. The last little piece there is that for those of you that are selling services rather than widgets, and it's really saying, what's my break-even calculation for services? So what number of hours do I require to deliver to break even? And the second piece is, how many services do I need to carry out to break even? So again, in that sort of environment, whether you're selling accounting services, whether you're servicing whatever it is you're providing information, whatever you're selling as a service, there's a couple of little formulae there. So I recommend you to get hold of that. All right. So the final one is staffing. Hang on, just let me go back. So that helps you there to do break even. Now, staffing is a critical one, and we talked about in the production environment about topping up, which is the middle one there, matching staffing levels to demand, seasonal or cyclical. So in other words, don't have a full core of staff on board that for half the year are sitting there doing nothing. Going to the top of the tree, change your staffing mix, permanent versus casual, sales versus administrative. Not much good having an office full of administrative people if you haven't got a sales force out there selling you, which derives your revenue. Look at having a core of permanent and topping up with casual. Look at utilisation. We did this in our business. So we had a receptionist looking all glamorous at the front there to receive people. She also got them set up on an online registration process. No clipboards in our business. It was all done on computers in reception. But we also used her to do accounts receivable, debt follow-up, talk to suppliers about accounts payable queries, all of those sorts of things. So utilise your staff. Look at staff incentives to reduce turnover. Look at creative ways to keep your staff motivated, to keep them loyal. You spend so much money training people, don't waste it all by letting them walk out the door to go to a better offer. And look at employment methods. There might be cheaper ways of employing people, but as I say, it's better to keep the people you've already got than to go out and here's me, a recruiter of the past, rather than going out and employing people, new people all the time. It's very expensive because it's the training process that really takes the time, the effort, and the money, the resources out of your business. So staffing as a change lever in cash flow is a critical piece. In my mind, it's a part of managing your overhead, but it's such a large part in so many businesses of your overhead that it deserves this particular attention. Staffing is a change lever on its own. And of course, the final one is your overheads, your expenses change lever. As I said to you, when you're putting your budget together, start at A and work through to Z, and you'll pick up all, have I got all the accounts captured? Is there anything new that I mightn't have spent last year? So use last year's profit and loss as your going in point to see all the expenses you've captured, but what else are you going to add in the next year that may not have been in your profit and loss that's going to have to go into your operating budget? Have I got them all captured? What's discretionary versus essential? Am I paying too little or too much? How can I reduce, defer, or eliminate any expenses? And make sure that you've always got a capacity to pay those things that are sitting as liabilities on your balance sheet as be it PAYG, GST, or superannuation guarantee when they fall due. And don't include any personal expenses. One of the things that I found that used to frustrate the nth degree was when I was doing due diligence on small businesses to find personal expenses intertwined in people's little businesses, which was really just undervaluing their businesses at the end of the day. Keep your personal stuff separate, but make sure you pay yourself. I do encourage you to do that. So look, preparing your cash flow. We're running out of time, and I do want to get to this last bit. It's your opening cash plus your cash in versus your cash out. Your opening cash comes off your balance sheet. Point in time, right now, your balance sheet now tells you what cash you got. So you don't need a cash flow for the past, you need a cash flow going forward. So it's prospective. So you're going to add on the cash you expect to get in from receipts, be it from cash sales or from receivables, and then the cash out is going out, your expenses, your asset purchases, your liabilities, to give you closing cash. Remember I said, it's simple. It's cash in and it's cash out. So what's it look like? Now, I apologize, this is a little bit blurry, but here again, this is an interactive Excel spreadsheet which we can give you, and you can mess around, change dates, change all sorts of information now. It covers a variety of sins. Top little quadrant up the top, starting off with cash on hand at the beginning of the first month. But then the first little bit is cash receipts, and that can come from cash sales. And if you've only got cash sales, there's nothing else to consider. It's just when you make your sales, come straight off your operating budget, your revenue budget will be your cash sales when you expect the months you expect to make them in. If it's receivables, then it's not your sales, but it's what's coming off your receivables. As I said, if you can get your receivables to come in very quickly, like we did in our business, then it's akin to getting cash in the door in the same month as the sales. So be aware of timing differences between cash coming from receivables and cash over the counter. There will be a lag, and that will flow into next month. So you might make a sale this month, you won't get the cash for it till next month. So there's a lag where you're working on that basis. Now, cash paid out is the main heart of this thing. Cover all your expenses, all your operating expenses, all your costs of labour, all your manufacturing costs. And of course, the next section down is any any other things, any exceptional things that have to come off when your cash paid out, which is like loan repayments or capital purchases, which will be oddities spread across the period. These are usually done in 12 months licks. It looks similar to an operating budget, but it's not your operating budget, it's your cash flow forecast. So remember the difference between these two things. So that's the document you're trying to get to produce. All of what I've said before generates this. It's simple, but it can be a trap for those of you that don't apply a thought process, a logical thought process about your business. So as I say, it varies very much from business to business. That's why we say our advice is general, because until we get to your business, we can't be specific. So, effective cash flow management summary. Am I trading profitably? I put enough aside. Is my business liquid? Does it have enough to spend on myself and pay others? And is my business getting ahead or falling behind? So let's do a quick check-in with our learning objectives and outcomes. And I hope that all of these things we've covered have gotten through and you've retained, that you do have a good understanding of cash flow, a good understanding of the 7 levers and how you can use them to optimize your cash flow, and have confidence to undertake and maintain ongoing cash forecasts in your business. So my final takeaways: keep your books accurately and up to date. Use a good software system that's going to stand you in good stead. Review your business performance regularly, and I recommend monthly. And budget. Don't ever give up on budgeting. You know, it's not something you can do once a year and just rely on it. It will change as your actuals come through and replace budgets. Measure your budgets against your actuals. Review, maintain, and adjust your cash flow forecast constantly. And don't be afraid to ask for help. Remember, garbage in, garbage out. Pay yourself properly as soon as the business can afford it, and build up cash for growth and new opportunities. Remember, cash is always king. So thank you very much, everybody. I hope that's been helpful to you. It's right on 12. I'm just going to hand back to Kylie. But thanks so much for your attention. And I do hope that there's some takeaways there for you today. Thanks, Kylie. Hand back to you.
Thanks very much, Graham. Thank you. And I did see one quick question come up at the end, which was a request for the cash flow management tools. So yes, I will send those out to all that were in attendance today. And just to wrap up, there is some information here on mental health and wellbeing. So there are some support services there that are all free, and they're relevant contact details. So Business Connect is a dedicated and personalised New South Wales government program that provides trusted advice to help you start, run, adapt or grow your small business. If you would like to reach out to a Business Connect advisor to access resources or get assistance, you can copy my details, which are in the chat log right now. And I will also be sending everyone a follow-up email with the replay to this as well, and the resources as mentioned. So if you're wanting more information about the Business Connect program, you can visit the website that is on the screen now. If you're wanting to check out upcoming webinars or have a look at the Business Connect advisors to find one that match your specific industry or criteria, you can do that at the website on the screen now. Thanks so much, everyone, for attending today. As I said, you will receive a replay email in the next 24 hours. And yeah, please reach out as well and respond to that email if you are wanting to book any subsequent follow-up sessions. Thanks so much for everyone who attended today. Take care, and we will see you again soon.
Thanks, Carly.
Thanks, Graham. Thanks.